And we'll get started. So tonight or this afternoon, we're here to talk about the Outdoor Hospitality Sun Fund. This is Happy Camper Capital's venture into the fund market. We're experienced operators already in the outdoor hospitality space, and that is campgrounds, RV resorts, and marinas. The fund is continuing with that same mission, but putting it in a very unique vehicle that has been at the demand of our investors and which actually already has a property closed into it. This is a fund that's ongoing, started in November 2022 and is going to close November 2023, so a little later this year. And we want to talk to you a little bit about, of course, the industry itself, the asset class of outdoor hospitality, and how Happy Camper operates and how the fund operates. Do you guys mind muting everybody in the room? Co-hosts? All right, perfect. All right, so anyway, so as I mentioned, let's jump in. We're going to talk a little bit about first how Happy Camper Capital operates. So just to give you a little bit of backstory on Happy Camper Capital, myself and my co-founding partner, Justin Hoggett, founded Happy Camper in 2020 on a houseboat with our families. We've told the story a few times. It shows up in other webinars. But we had a mission to buy campgrounds for our families to enjoy and also, of course, to help build our net worth and create some passive income. But we can't leave well enough alone. So, of course, we decided to grow into a larger operation and figure out how we could get a larger number of those campgrounds. We threw a number out there of 100, and we're still focused on that number in the long term. So Happy Camper Capital was born. We began building the team about a year and a half ago. We've got an acquisitions team, which, as you met Bradley Claudianos already. We've got Justin Nanny, who's also part of that team. We've got our investor relations, which Don Spafford came in as investor relations, has since elevated himself to a partner within the firm. Ramesh Nachapan is also investor relations with us as well too. So what Happy Camper Capital does is we bring performing and value add RV resorts, campgrounds, and marinas to our partners. That's you guys, our investment partners. We have targets and certain goals we're looking to achieve, for our investors and of course for ourselves. And typically those, of course, are going to be to attain above average cash flow returns, appreciation in your asset, of course, and then accelerated depreciation, the tax benefit that comes from that. So, this might mirror a lot of other real estate investment opportunities you've seen out there, the big differentiator being the asset class. I also like to say that we have a very unique structure we have formed for this fund specifically, and how it operates compared to some other investment funds out there as well. So what our process involves is we have our acquisitions team who's out there scouting and looking for properties to purchase, to put out as an investment opportunity for our investors. We pride ourselves in sourcing many of our opportunities off market. So not going through brokers, which obviously those brokers do a great job for their clients of getting top dollar on the properties they sell, but that doesn't always work well in an investment model. We go direct to seller, and we have opportunities to buy into a lot of these properties at or well below market rates, where those are at. So we do our own negotiations and contracts in-house. We also do our own due diligence and inspections in-house as well too. In fact, when we got into this business, there wasn't a robust checklist or process for transient campgrounds and performing due diligence. I'd like to say we've written the book on it. In fact, we actually created the course on it to teach people how to do it. And we've created processes that we, from our learnings along the way to ensure that we're buying the right properties and that we aren't met with any unexpected landmines after closing, or at least doing our best to mitigate those that come up. Of course, once we found an opportunity that meets our rigid criteria, we do have a very strict acquisitions criteria list. We present those to our sophisticated investor community, that would be you guys, to help us come along and partner on these ventures to bring them in. And then to add to that, when we formed this company, we started a management company called Beyond Our Camp, who manages our companies. And that's a major benefit to the investors, knowing that we control the management company. We aren't left at the whim of another company out there. And our management company is focused on making these properties cash flow, and also, of course, improve their value over time. So a unified focus as we move forward. So if you're new to the asset, if you haven't looked at RV properties before, let's talk about why you might want to consider buying an RV destination, why this is something that we are so excited about and we think you need to know about. First off, this is not a dying asset that is going out with the baby boomers, going out with grandma, grandpa. This is something that the younger generations are embracing, in fact, at greater numbers than their parents and their grandparents did. 38% of RV owners are millennials. And that's not including the Gen Zers who are coming up now and who are also getting into this space. A lot of that was really driven, I think, or maybe accelerated by 2020. We already had a movement for a lot of these young workers to be remote workers where they could, use tools of the internet. 2020 accelerated as we got tools like Zoom, like we're using to meet here today. And a lot of these jobs went where they could be mobile. So a lot of these younger families who were also in the midst of a housing market boom where they couldn't afford to buy a first home as they were coming of age, took to the road. They moved into RVs. They chose to go explore. They ended up being great users in our campgrounds. A lot of them are young families, so they want good amenities for their kids. They want, good Wi-Fi for doing their work. These are amenities that we look to provide with our management company, Beyonder. But this is also what is giving me confidence as we move forward in this asset class, that this has staying power. And like I said, this is not going out with grandma, grandpa. So, of course, we also saw in 2020 that there was some resiliency through a recession. We experienced by definition, recession in 2020 with 2 quarters of GDP decline, and RV destinations couldn't have done better. In fact, a lot of the campgrounds we look at had their best years in 2020 and 2021 sequentially. The trend has continued. It didn't die off in 2022 once we got through a lot of the COVID stuff that happened. It continued forward, maybe not at the same clip. That the growth rate we were seeing maybe wouldn't have been sustainable long term, but we are still seeing sustainable growth, and our projections continue into this year. So I mentioned, of course, we have a set of acquisition criteria we work within. Every time we look at a potential property, we aren't throwing a dart at a board. In fact, we're more or less sniping for the right opportunities out there. We are looking for properties that have RV camping as their main revenue. And this is incredibly important too when we talk about the fund here today, where investors coming in today don't know what the assets are going to be going forward, aside from the one that's already in it as we close out. But rest assured that we have a very rigid set of criteria that we put every opportunity through to make sure it's the right fit for our model. So obviously RV camping being one of our main sources of revenue is a big one for us. There are a lot of RV camps out there that are maybe attached to a C-store, a convenience store, where they sell gas and cigarettes and things like that. And that's not really our model, because a lot of income is going to be derived from that. And that's a business we don't know as well. But what we do know is outdoor hospitality. We know transient campgrounds, we know marinas. This is our space. We have a certain size requirement that works with this model, because when we purchase these, we are leveraging these with debt, meaning we are taking mortgages on the properties when we buy them. So to make our model work with the investors and to provide the returns we're looking for, we're typically looking for properties that have a minimum of 100 sites or rental units. So these can be RV sites, these can be cabins, maybe motel rooms. We have some small motels that are attached to a couple of our properties. These could be glamping units. So those really cool glamping cabins or covered wagons or yurts or things that you see people camp in. The main idea being we need to have a large enough revenue base that comes in from camping. We want fun attractions. Again, we are not going for long-term living. We are not going for the RV communities that are more or less like mobile home where people live full time. We're going for vacation properties that people go to spend a weekend, a week, some cases a month. It just depends on what it is. So we need a lot of fun attraction. We find water brings people in. So that's always a requirement in our properties. There's got to be some sort of water on site, or the ability for us to add it, if there's not already a pool and a hot tub, say, on site. We like outdoor games. Again, a lot of these are young families, younger people who are traveling, who we are focusing on as our demographic. So we want to make sure that we have those attractions that bring people in, that we're near the attractions that are bringing people to town. And then, of course, that we have opportunities to bring in other revenue streams. That is one of the biggest hidden benefits of RV camping, is the ability to add tertiary income streams, to go in and put a camp store if there's not already one in place, to put rental units in, to add things that, golf carts that people can rent. We make an incredible amount of money renting golf carts. Selling beer in your camp store. There are a lot of things that a lot of the mom and pop owners, this is still a predominantly mom and pop industry, haven't implemented, that are just simple opportunities for us to go in and really ratchet up the revenue, and make these things perform well. We have requirements about where we're located when we buy our properties too. So we like to make sure that we are within 100 miles of a major city. That's a big thing for us. We want to make sure, because what we found, and this is a question that has been coming up in the past year as it relates to fuel prices. Fuel prices went up. People didn't stop camping. They just changed where they camped. As opposed to driving cross country to go to a national park, several state lines away, they're staying in their own backyard. It's not that they're wrapping their toys up and saying, well, we'll get them out again next year when gas prices go down. They still got them out. They just stayed within 2 hours of their home, is what we found. We actually use software systems in our campgrounds. We've been able to track this and find out where our user base is from. Last year, a couple of our campgrounds, we found out that the majority of the users lived within 45 minutes. They just want to get away from the weekend, get away from their home, go out and have some fun. So being in proximity to those major cities is not only important for that, but also making sure we have the staffing we need to run these campgrounds, having the vendors that we need, any contractors we might require, and you find that near major cities. So that's always a major requirement for us. In addition to, like I said, being near major attractions, accessible from highways. And then, of course, big thing, most important for investors is we want to make sure that we're hitting certain performance metrics. Although we strive for a year 5, 15% cash on cash, and a lot of our projections tend to beat that, what we're looking for is a 12-year average of 12% cash on cash. And that's just in our initial underwriting. So for us to move forward with it at all, it's got to be in this box, more or less, to keep the conversation moving forward. So that's a little bit about Happy Camper, how we operate. That's not necessarily specific to this fund, although it does have bearing in it, because we're operating the fund the same exact way we've operated our first deals, which were each syndicated on a one-off basis. So the Outdoor Hospitality Sun Fund was created by us at the request of our investors who were looking for things like evening out the seasonality in this industry. As I mentioned, this is a hospitality business, and it doesn't matter which part of the country you're in, there is a seasonality. If you're in the northern states, it's forced more or less by the winter. When there's snow on the ground, people don't go out camping as much. In the southern states, it's heavier in the wintertime than it is in the summertime, obviously the cooler months, but there are opportunities year round. We, of course, look to seize those opportunities. However, what we were finding is we get much higher cash flow in the peak season, less cash flow in the other season, still great returns, but people want to see that balanced out. So that was actually what really drove the initial conversation on the fund, was the ability to balance out those cash flow ebbs and flows. So, but what it ended up doing is creating diversification as well too. We can't predict what's going to happen with natural disasters in certain states, but if a tornado comes through one state or a hurricane through another and devastates a campground, we still have other assets that are performing in the portfolio that can keep the fund solvent. Now, all that to say, and I'll add a cliff note as it relates to natural disasters, we've focused very heavily on the insurance we put on the properties. It's one thing we absolutely don't skimp on. We certainly underwrite for and buy the best insurance we can get. One of the big things we do is loss of business income. So if we did have that hurricane that came through and wiped out a campground, we can make sure that we can make a claim against it, and that loss of business income at least covers our preferred rate of return to the investors. So we'll talk a little bit about the fund structure and how this operates. So a lot of these, if you've looked at a Happy Camper deal before, a lot of this is going to look very similar. We did add a couple of share classes for the fund because obviously this is a longer term investment, at least as far as how long it's open than our traditional syndications. But our structure is a GP-LP structure, where our limited partner investors, that would be you, the passive investors, come in with 65% ownership. We, the company, are 35% as general partners in the fund. We offer 3 classes of shares, and I've got a really great bullet point I'm going to add to this in a second here. And it's dependent upon the amount of capital invested. So a Class C share is for anybody who invests from the minimum, which is $100,000, to $250,000, and they get an 8% preferred rate of return. Anybody who invests from $250,000 to $500,000 is a 9% preferred rate of return, and anybody who's $5,000 or above is a 10% preferred rate of return. Now, here's the best part about this, and this is something that I don't know any other fund that's doing this. Or Ramesh, you can tell me if you've ever seen another fund that does this. But if you were to come in and let's say your first investment you made was $150,000, that would be a Class C share, 8% preferred rate of return. But then 2 months later, you were able to invest another $150,000. You're up to $300,000. We would bump all of your shares up to that Class B, up to that 9%. Ramesh, have you seen that before?
Oh, that is the reason we designed it this way, right? We just want to be unique. And when we say, we really take care of investors, we mean business.
Absolutely. And, and in that same scenario, we get close to the end of the fund and you realize you had $200,000 that you just came across. Maybe you sold a property, sold another investment, another one closed out, and you put it in, all of your shares would be moved up to a Class A share. So we do allow you to ratchet that up. And it only ratchets up. So if we performed a return of capital event at any time in the life of the fund, which will happen as we liquidate properties, as we start winding the fund down near the end of its hold period. And if we return your capital below that threshold, we are not going to ratchet your share down. So the shares ratchet up, not down. So if you came in as a Class A share, right at the minimum of the Class A, you're going to be a Class A share all the way to the end. So that's a big benefit. We have so our first hurdle, of course, is in the cash flow distribution on this is that investors get all of the proceeds until the preferred rate of return is met. So that 8, 9, or 10%. Once we've made the preferred rate of return in a given year, it's a 65-35 split until we hit the waterfall threshold based upon the internal rate of return, the IRR. And of course, that's going to be at the time of exit, at the time of liquidation, when those IRRs are calculated. Those do stair step in accordance with the Class A, B, and C shares. And of course, anything above that IRR threshold, the ownership on those remaining proceeds shifts to 50-50. It's a lot. And of course, we're happy to explain this to you offline in another call if we want to mock this up. If you're not already experienced with these types of thresholds, it's okay. We'll walk you through it on a separate call with our investor relations team. We do pay quarterly distributions when distributions are available. We typically begin distributing at the end of the first full fiscal quarter, meaning once we've owned the property for one full quarter, if there are distributions available, that's when they will be made. We don't withhold them longer than that generally, unless we were doing a ground up development, which this fund doesn't have a mission of doing. We're assigning our fees on a property to property basis, which is why you do see a range on a couple of these fees here. Some funds charge an upfront fee. When you put the capital in, the fee is assessed immediately. In our case here, we wanted to do, as Ramesh mentioned, what's in the best interest of the investor, which is by assessing no upfront fees. We're only assessing when we perform on a deal and actually have a deal close into the fund. So we did provide a range because we do move the fees based upon the deal size and the deal complexity. So our sponsor acquisition fees, for example, can range from 2 to 4%. Our most recent acquisition, the one that actually just closed into the fund, closed with a 3% acquisition fee. So these will vary. If it's at the higher purchase price end of the scale, it'll be on the lower end of that fee scale to keep it within reason. The asset management fee, of course, is just for all capital in the fund. Property management fee is, again, that goes to BeyondCamp, the management partner. And we do, of course, bill at a lower rate. BeyondCamp does offer third-party management to other campgrounds. This is a very complex management system to implement in a campground. A hospitality property has a lot of moving parts, requires a lot of staff. We charge other campgrounds 12% to manage them. We're obviously providing a discounted rate to properties that are in the fund or in Happy Campers Holdings. And then the loan and financing fee, this can be a guarantee fee if we're guaranteeing a loan. Or obtaining financing is going to be between 1% and 2%, depending on what the size of the deal is, and of course the needs of the property are. That's for the sponsors and or other guarantors to guarantee the loan when needed. All right, so the investment strategy in the fund, like I mentioned, of course, we're looking to buy in multiple markets. This is actually our intention. Some funds might target a market. We target an asset class, which again is outdoor hospitality. This helps us mitigate those natural disaster risks or any regional event that could affect camping in one particular area. As I mentioned before, of course, this is a seasonal asset. we do and this is actually one of the benefits that I love about this asset class is we walk into a lot of these campgrounds. Again, these are mom and pop owned in a lot of cases, where they retired. They work 80-hour weeks in the peak season. They don't want to work in the wintertime. So they'd shut their operation down or, do minimal activity in their off-peak season. And we walk into these campgrounds, we now have the opportunity to accelerate what they've been doing in the peak season, but also implement things in the off-peak season to produce that income. Great example would be we had our campground Beyond Our Getaway Lazy Acres that closed last summer. That campground produced zero income before we bought it from October till April, because the owners shut down the whole operation, locked it up, and went away for the winter. As soon as we got in, we made several of our sites winter ready, and we have produced enough cash flow all winter long to not only keep our manager and maintenance employed, but provide cash flow income. So that's one of the beauties of this seasonal asset class. However, even though we do our best to bring up those off-peak seasons, we still wanted a way to blend this to keep the cash flows consistent year round. In the fund, we're targeting what I call blue chip properties. These are ones that we're not taking a big gamble on. We're not going in and trying to, doing an experimental concept. We're buying properties that are performing in markets that are performing. We're making common sense upgrades to these and expansions where necessary. We're not looking to flip an entire business model. A great example of that would be, there are folks who have tried to take mobile home parks and flip them into campgrounds. That's a risk. And that's when we're not taking the fund. We're buying, again, outdoor hospitality properties, and we're putting them in that are already performing. There are going to be multiple properties in which are going to provide a lot of benefits. A couple of those being those properties that close later are going to be the ones that liquidate latest. But an investor who comes in even at the tail end has the ability to gain some benefit from properties that liquidate early. And I'll talk about the liquidation before we end today. I promise on that, and what our planned hold period and planned life cycle of the fund are. We do have a capital improvement plan going into every property. In some cases, it means making repairs and upgrades to, maybe antiquated systems that are in place, or it could be expanding, adding additional sites and amenities, things that we know are going to produce additional revenue for the campground. And then, of course, we have a very unique management model that we implement to make sure that our managers who are on site in these campgrounds are incentivized through a bonus structure to actually improve the revenues and the profitability of the campground, make sure that the ratings are up, which all of these things are going to translate to a long-term resale value that's going to be, within our expectations as we move forward. So typically when we go in and we begin operating a campground and we begin implementing the Capex plans, we have a 5-point plan that we go through. So the first one, of course, is going to be just optimizing the revenue. A lot of these mom and pop campgrounds, have been run like a mom and pop. They have one fixed revenue, one fixed rate that they run for every night of the week, every day of the year, because they want it to be simple. They want somebody who phone calls in and makes a reservation. They can do a quick multiplication, 4 nights at $25 a night is $100, which is great. It's simple for them, but they're leaving a lot of money on the table. The hotel industry for years has used what's called yield management to help drive revenues higher by looking at the occupancy, looking what events are going on in the area and setting the rates accordingly. We are using this technology now with software that was designed for the hotel industry in ours. And this alone, if a campground doesn't have online reservations, just adding it, we're seeing on average around 5% increase in camping revenue. Then adding yield management can easily be another 3 to 5% increase in revenue. These can be major, major increases just from using technology solutions. And it actually reduces workload on our staff from having to answer the phone and take all those reservations. So the other thing we look at, of course, is how we can expand our rental unit offerings. If we have a campground that is maxed out, they have a waiting list, or the reservation slots are always full, we're looking for ways to add more availability and more sites. A great example is going to be the very first property that I'm going to show you here on the next slide. The very first one we closed into the fund. It's in Louisiana. It's a great resort, beautiful property. Its occupancy was high enough to justify us looking at the piece of land next door. We're actually in the process of purchasing right now to expand and add more RV sites, to add more amenities to the property. We look at amenity improvement, knowing that having the amenities that bring people in will not only increase revenue by getting them to stay more nights, by giving them fun things to do, making it a destination to come to with their family because the kids want to play in the lazy river at the campground in Louisiana I'm talking about right now, or the adults want to hang out at the cool bar that we're planning on putting in. But in addition to that, you're also going to be able to justify higher daily rates just by having those amenities. So it's really a 1-2 punch of being able to get that revenue up through those amenities. Of course, looking at expenses and how we can trim those, this is a big benefit of having a multi-operator management company, is that we are able to share some of our expenses to help reduce the load on the individual campground. We centralize all of our payroll right now. We run it all through the Beyonder Camp level. Our human resources are all shared at the Beyonder Camp level. Our phone systems are all tied through one account where we get better purchasing power just in that alone. Same goes for our campground software use. So we share a lot of expenses, which really helps reduce the expense column for the individual property. And then, of course, the first thing we do when we close a property, every one of our properties right now is either has had a cost segregation study completed or is underway on having a cost seg study done right now, so we can look at the accelerated depreciation opportunities for our investors. So that is the Happy Camper and Beyonder business plan. The first property I want to show you is the one I just referenced. This is Beyonder Resort Cajun Moon. This is in Sulphur, Louisiana. This closed December 14th, 2022. This is a 128 site premium RV resort, concrete pads throughout, full hookups at sites, great amenities. We got 2 pools, a lazy river, a hot tub. It's just a super great property. We're in the midst of buying a piece of land. Next to it, you can see the tree line on the right side of this picture. That goes back into a bigger piece of land where we're going to be adding another 70 RV sites. We're in the process of getting that land entitled and zoned right now, getting the pre-engineering done so we can do that expansion. And then, of course, improve the amenities on this one here. This is a great property. This one just closed in, so that anybody who invests today would not only take ownership in the upcoming properties, but also in Beyonder Resort Cajun Moon. We have several other opportunities we're looking at right now. We've got a couple that Brad Acquisitions is working on that are going to be potential opportunities to go into the fund. We'll have more details on those. In fact, we've got one potential opportunity right now that I'm going to share with you on screen here. This is one that is on a tight timeline. We're still making a decision if it's going to move forward into the fund, but this is an RV resort in Ohio. I cannot share specific details on this one right now, just because we do have a mixed audience of people who may or may not have signed our non-disclosure agreement. So if you do want to know more details on this particular property, in our investor portal at investors.happycampercapital.com, which I'll share at the end, we do have more details on this particular property. But this is a large RV resort, $12 million purchase price on this one. The cap rate looks, maybe a little out of proportion for what a campground would normally trade at. And that's because this property actually has a brick and mortar RV dealership on it as well too. Now, I mentioned, of course, that we like to stay in our lane on the businesses we operate. However, one of our partners, through our network, was an RV dealer owner for 30 years, and he is consulting with us on this one here for the operation of the RV dealership. So provided we move forward with this one, close on this one, and put it into the fund, this one here has tremendous potential. Last year's net operating income on this property was $2.4 million. It's a strong performer, a lot of room to expand. It has 40 additional acres on it, for which we can add more RV sites to it, improve the amenities. There's a lot with this one here. We are on a short timeline to determine if we are moving forward with this one. So I can't promise this one would necessarily go in, but this is the type of property that will go in if we hit certain metrics and if certain conversations happen. Like I said, I have to be careful with how much I say in the public forum, just not knowing who has signed our NDA and who hasn't. So, of course, there are details about this for those as specifics, including the name, in the investor portal for those of you who would like to go in and see that. So investors.happycampercapital.com, if you have not already joined the portal, is where you'd find more on that. As far as the operation, I mentioned Beyond Our Camp is our management company. This is something we're very proud of, like I mentioned, to actually own and control is the management company, because anybody who's ever owned an investment property of any kind knows that if you outsource the management, you're really leaving the whole operation to chance, and you're relinquishing control. And at least, in the single family, multifamily world, which is where most of us come from, typically nobody knows the pain of vacancy like the property owner does when you hire a landlord, or somebody else to do your landlording for you. So it was important for us to have this control to make sure that we had our finger on the pulse, that we knew that our Capex plan was being implemented, our revenue management plan was being implemented the way we want it to be done, and that we had a focus in our day-to-day operation, not only just on the guest experience, which is a top priority for us, but also, of course, in the profitability of the campground. So Beyond Our Camp is our management company, and there's more details on that at beyondourcamp.com if you want to learn a little bit more about that. You can also see our existing portfolio of campgrounds in there that we own and operate. So just to recap, the mission of the Outdoor Hospitality Sun Fund is to put multiple properties in that have either expansion or value add components to them. These are going to be campgrounds. These are going to be RV resorts. They're going to be marinas. They're going to meet our acquisition criteria, which I outlined earlier. And of course, I'm happy to share in further detail. They are going to be targeting consistent cash flow just by having properties in different markets in there. They're, of course, going to be looking at different hedges against market risks. So things like, again, those natural disasters that could affect a certain property. We're going to be looking at the great upside on the back end, but of course, by maintaining the income, these are capitalized properties. So when we go to sell these, it's going to be on the performance of the business, not just on the asset value alone. And then, of course, making sure that we're maximizing that accelerated depreciation, those tax benefits for our investors. So, and of course, back to the roots, back to the beginning when I told you why Justin and I founded this company to begin with. We really believe in having assets that you can actually go enjoy. A lot of us who are investors in real estate, we say we invest in it because we can go touch it. If you have a rental property, you can go touch it, you can go see it, you can actually look at it. I take this a step further, and I take my family to go vacation at these properties, and my kids get to go enjoy the amenities, and they get to go work in the store. And this has a personal connection for me. I hope it has a personal connection for you too as well. And if it doesn't, then the returns probably will, and that at least be something that might motivate you to consider an investment in outdoor hospitality. So I'm going to open up the floor as we move forward through some of our last slides here. For any questions. Don, Ramesh, Brad, do you guys mind maybe just seeing what we've got in the chat as far as questions go, and then we'll open up for any open mic questions we have?
Yeah, there's a couple of similar questions in there so far regarding the asset management fee.
Yes.
Because you kind of showed that a bit earlier with that slide about the fund. So there's some questions here as if the asset management fee is based on the assets under management in the fund. And therefore it's a fund fee, or is there also a separate management fee of the assets? So you might
the asset on that. Yes, good question. So our asset management fee is based upon the effective gross income of the assets within. So if we were to, let's say, for example, take all the money into the fund, raise the $25 million and not deploy it, zero asset management fees would come in. So it's not based on the capital in the fund. It is based on the performance of the properties that are within the fund. And when I say effective gross income, what I mean by that is the gross sales minus any cost of goods sold is what we use as the benchmark, both for our asset management fee and also for property management fee calculations. What's next?
Yeah, Janelle, is there also is there a disposition fee?
There is.
It's not shown there.
Yes, there is a disposition fee. And of course, there are a lot of scenarios and fees that could come up. I'm not able to fit all of them in here, nor do I necessarily want to, throw too many numbers out there. What I will say in this case here, just because I don't have it as a bullet point reference in front of me, is that the PPM is the private placement memorandum is in the investor portal, and that can actually be accessed without even being logged in. So if you didn't want to give your information to get signed up for the portal, that's okay. You can go to happycampercapital.com/funds, FUNDS, and you can see the fund details. That's our main fund landing page, where you'll be able to see the PPM. You can actually read the agreement. We put it all out there for you. Nothing's a secret. You'll be able to see any potential fees that could be assessed.
So for one more question is, what's the expected exit cap rate projection? And I don't know if that's on any specific property. We're looking for the fund as a whole in this case.
Who asked the question?
Don't want to say the name wrong here. I'm sorry. Hi Sao.
Okay, yeah. Hi, Sal. If you don't mind, just let us know which property were you looking for the projected exit cap rate on? Was it the was it Cajun Moon in Louisiana, or was it the one in Ohio? You can either come off mute or you can put it in the chat.
If there's any more questions, feel free to either put in the chat or also maybe.
Yeah. And I'll just actually say as a generalization. So even though we anticipate the cap rates in this asset class to continue compressing as they have, when we first got into the space, campgrounds were trading in the 12 to 13% cap rate range. Last year, they were compressed as far as about, I would say if they were listed with brokers, they were trading around the 6 to 7 cap range in some cases. We've never bought anything below an 8 cap. And like I said, I take a lot of pride in the fact that our acquisitions process has gotten us in front of deals, at better prices than other people would have gotten. But when we do our projections, we are projecting very conservatively on that. We're like right now we're analyzing exit cap rates in the 10 to 11% range. So projecting, because the cap rates have, inverted, they've gone the other way this year as bank debt and interest rates have gone where they are. We've seen cap rates, listed with other brokers going in the 8% range. We're underwriting now in the 10 to 11% range on the ones we're purchasing, but again, expecting they're going to trade at their exit. So I didn't talk about the exit process, which that did remind me of. So I will explain that. Every property we bring into the fund has a planned 5-year horizon for that property, and the reason it's 5 years is we typically are looking at about 1 to 2 years for the full deployment of the Capex plan going to these projects. That's going to be any improvements or expansions that we do. Depending on the complexity of it, if we have to get a property rezoned, we have to get certain entitlements, permitting, the engineering. That alone can take 6 to 9 months in some cases before you've even broken ground, let alone the construction itself. So giving us a 2-year window to make sure our Capex plan is completed, and that we have another 2 years to get the property stabilized, meaning, of course, getting those new sites and amenities used, getting the income in, getting the books stabilized and seasoned, so that we are prepared for a liquidation in and by the 5th year. Now, we have a fund horizon of 8 years. And the reason it's 8 years for the whole fund is that even though we are very good at finding deals and we have plenty of deals in our pipeline lined up for the capital as the fund is filled, if we were to get to the end of the fund, we're giving ourselves an extra year to buy the properties into the fund after it closes. And of course, the reason for this is we aren't looking to buy any property. They have to fit our acquisition criteria. We're not going to settle on what we put in just to fill the fund. And of course, we want to make sure we have the right one. So if we were to close on a property, it'll actually be the fund will be open 1 year this fall. If we were to close on one at the end of year 2, then we're allowing 5 years for the life cycle of that property, plus a year for doing all of the liquidations and all properties. So the maximum horizon on this fund that we are anticipating is 8 years. Of course, this could end sooner. If we achieve our goals sooner and the properties liquidate sooner, and the fund is performing above what we expect it to, we may be looking at an earlier exit on the fund.
So the question from before was specifically to the fund itself, that fund exit cap rate. If we can even, I guess we can estimation on that, because there'll be kind of multiple properties in there to get that sum total. But
that's right. Yeah, so, and obviously we won't know what the exit cap rate will be. It's going to be based upon what the market demand is at the time of those individual liquidations of the properties. So it's tough to say. We are underwriting what I say on the highly conservative side. I expect that this asset is going to continue compressing. Obviously, like I said, we saw a little rise in cap rates this last year, driven a lot by interest rates where they were. I expect that we're going to, but every asset class did for that matter. So I expect that we're going to continue back down once we get through this current market condition we're in. and that we're going to be the likes of multifamily, self-storage, mobile home, and several of those other assets that started with high cap rates and compressed, which of course is a major benefit for us investors just by virtue of being invested in the asset, seeing growth just through that cap rate compression. What do we have next?
You mentioned that millennial 36%, or I believe 36% of them are millennials now. But the normal RV market is, I believe, empty nesters, right? So when you are making your projection based on the new new demographic because of the COVID, have you done it without taking that into account? Because the expectation is everything will slowly get back to what it was before the COVID. Right?
That's a good question, Kumar. I appreciate that. Yes, and actually, so we use, and obviously, 2020 threw something at us that nobody could have expected, right? And it didn't necessarily change what was happening in the industry. The industry was actually already headed toward a younger user base. What it did was it accelerated it, the rate at which it happened. So we have studies and information. In fact, I'll tell you this, one of our competitors in the business, KOA, Campgrounds of America, and I shouldn't say, I wouldn't say it's an adversarial relationship. We're certainly competing with them for clients, but we really respect their model and their research. They provide a North American camping report every year where they pay a third-party agency to conduct studies for them on their user base and where campers come from. And of course, if you go back 5 years on that, you find that there was already a trend of younger users coming into the space. It was accelerated, but some of the great data points you'll find in there, and I don't have the specifics to back this up, so I'm not going to try to quote a percentage on this here, but the percentage of new users who got into camping, who said that they would continue camping after doing it for the first time, that number actually rose going into 2021, out of 2020 when people were surveyed. So that, along with the number of new users coming in, is a really positive sign for us going forward into the future. Our other leading indicator in this industry is the actual RV industry itself, who produces the RVs. The RV Industry Association of America, they share their numbers, and the RV sales have continued to trend upward, even though they took a small dip in 2022, but that's only because the orders that were taken in 2020 and 2021 were in some cases triple what some of those manufacturers had taken in prior years. That number wouldn't have been sustained. It's still greater numbers than what past years would have seen.
Adam, I would like to add, based on all the data analysis that we do in-house, right? So far until 2023, the baby boomer population is the largest population in the United States, right? And that is turning out to, like, millennials are going to take over the baby boomers end of 2023, early 2024. And that is one of the main reasons on these spending cycles, even though the interest rates are high, inflation is very high, still not a lot of things are coming down as Fed is expecting, is because of the millennial Gen Z spending habits, because they're not tied to an asset. They're not, they're very remote, traveling. And one of the things that, based on anybody who wants to go out for a weekend, the immediate step might be going to a beach or hiking or a park. But the next steps is definitely who has RV vehicles or boats. Those are the two things that's happening in the industry as of now. From in the last 10, it took like 15 years in the RV industry to double the RV numbers, right? Which the market is predicting that is going to happen in the next 6 years, like half the time than the previous time, and the numbers are going to kind of double. So there are like 11 million RV vehicles in the country right now, and they're expecting it might go up to 18 to 22 in the next 6 to 7 years.
Yeah, absolutely. Kumar, did that help answer your question, or did you have more to that?
Yeah, I think I got it.
Okay.
And you mentioned about depreciation, right?
Yes.
When does it kick in, or can you explain that?
Sure. So obviously what we're looking at is accelerated depreciation. And just for anybody in the room who doesn't understand what that means is obviously typically when we look at an asset, less the real estate itself, the actual dirt, the land, the buildings, the improvements, anything else in the land, those can be depreciated on a tax schedule that, that typically for this asset class is 15 years. But what you can do is, of course, you can have a cost seg study done, and I'm going to say this in as simple terms as possible. Look at certain assets that can be accelerated in their depreciation on a much shorter schedule. So, I'll give you a great example. Don, if you don't mind me putting you on the spot for this, Don's been the one who's orchestrated all of the cost seg studies we've had done thus far. From your initial look at the results back in that, what are you seeing as far as what those accelerations look like, and what sort of percentages of the assets are depreciated?
Yeah, so from the ones we've ordered so far, I mean, I'll say that even the cost segregation expert himself, like the tax advisor, he himself was shocked at how high the returns are on these. And I've heard that from some other cost segregation experts as well, that the potential depreciation on these properties can be huge. To be honest, I don't know the exact numbers off the top of my head from the ones we've gotten back yet to see those percentages to give you that. But I said, again, even the guy doing the cost segregation study, he himself was surprised at how high the numbers were as compared to what he's used to seeing with multifamily or other assets. So let's give you that.
Yep. And so a great example is, the cost seg study on Cajun Moon, which was closed in December, is ongoing, but is going to be applicable for the 2022 tax year. So that's actually going to be going out on K1s for Q4. So that there will be depreciation on it immediately.
You mentioned about natural disasters, right? So do you take insurance on this, or how does it work? Does it come under the overheads?
Yeah, good question, Kumar. Absolutely, we insure these properties, and I will tell you this: we don't skip on the insurance. To give you a great example, our most expensive insurance policy is on Beyond a Marine Sterritt Creek in Missouri. That's our marina property. We pay $120,000 a year for insurance on that property. Every asset on the property is insured against loss from natural disasters. You name it. That we have very comprehensive coverage on it. And to include, and I'll reiterate this, we insure for loss of business income also on every one of our properties. So, and when we calculate that number, we calculate it based upon the preferred rate of return that we have to make sure that if we were to have a total loss on an asset, which is incredibly rare, even the couple of assets we have who have seen storms in the past have never seen a total loss. But if we were to, then we would have enough to cover the preferred rate of return.
Thank you.
Of course, absolutely.
Hi, Adam.
A couple more questions. Oh,
Hi,
sorry,
Ting. Good to see you again. How are you?
Nice, good. So I have a couple of investors on the call, and I would like you to go into a little bit more details about the early exit strategies that you guys offer, because it's something that's not very common in the multifamily world. Most of the time when you invest into something, when we say the holding period is 5 years, 8 years, and you can't really get your money out. But in your particular case, in this fund, that there's a possibility that people can get their money out, but obviously there's a redemption fee. So can you expand on that?
Yeah, absolutely. So, we will have liquidations that happen along the way. Great example might be, let's say Cajun Moon, our first one we closed in, performs above our expectations, and we decide at year 3 it makes sense to liquidate that property. Our plan with this fund, it does have a finite horizon. So we are not looking to go reinvest those funds at that point. So that would be a return of capital event to the investors at that time, which is going to be one means of potentially getting that out. Another means of getting that out, of course, could be if somebody wanted to exit and sell their shares. We do have a mechanism in place to sell shares. There is a process, of course, for us where it does go to the sponsors first for the first right of refusal before it goes to other members in the fund, and then ultimately to a potential outside investor who's coming in. But those are going to be the main potential early exits before the fund's 8-year horizon.
Okay, great, thank you.
Of course, absolutely. All right, Ramesh, I'm sorry. Don, go ahead. Yeah.
Yeah, there's a couple more questions in the chat there. So first of all, who will be managing the development until stabilization and operation?
That's a great question. We've actually got a gentleman working for our team named Chad. Chad is our project and construction manager. So he's overseeing all of the developments and projects on our properties right now. So this is going to include, at Sterritt Creek, we're adding a new dock right now. We're adding new sites at Lazy Acres and at Rising Sun. And he's going to be managing the construction on Cajun Moon here as soon as we get the new land secured. So Chad is our main guy for that. We certainly, it requires a full-time specialist. Finding contractors, interfacing with contractors is not something we, the principals, have the time nor the capacity to do.
And then will investors have an option to, I guess, continue owning ownership in the properties even after exit? I think meaning is and like a not be paid out when the property exits, but still hold equity in that deal. I think that's what they're asking here.
Good question. So that, and I'm guessing that's in relation to the liquidation events. So the answer to that would be, the simple answer to that would be no, but and the reason for that being, we may end up liquidating to an outside party is a possibility, right? There's always a chance that we're, as you can see, I've got the exit strategy listed. Any liquidation or sale event does require a 75% voted investor member. So of course, that's one thing I want to hit on first, is just to say that even though we, the principals in this, do want to purchase the properties at liquidation, which I think is a benefit to know that there is a potential interested buyer if the market were to change. If there were a more advantageous situation for us to sell to an outside party, that is a possibility. If the, and if, of course, if we, the sponsors, do end up making the purchase, it would probably be into a different entity. So, not to say that, partnerships with certain investors couldn't be made at a later date. I'm not going to say that's not a possibility, but it just, for cleanliness, we are looking to liquidate the entire fund at its winding up. Any other questions?
Do you share your exit strategy anywhere?
I'm sorry?
The exit strategy you mentioned about, there is a mechanism to do that, right?
Yes, it's actually detailed in the PPM. It explains exactly how that works.
Thank you.
Of course.
Adam, one more question. I forgot to ask the perks for investors. I think last time we talked that you guys were offering investors like certain states per year that they can actually access these perks.
That's right. Yes. And we have changed that. My partner, Justin, who he had to run out to get his kids, so he wasn't able to stay on, but he's the one who designed the incentive program for investors. So I don't have the actual number, but there are investors who are invested, get obviously to use their properties. We do have a certain number of days per year that each investor gets to use their properties and go out and enjoy them. And then, of course, certain discount structures that go in place to either give to friends and family or to use when you're at the property. But yes, of course, like we said, that's one of the things that we love about these, is our ability to go use these. So we want our investors to go visit them and stay at them as well too. So I do apologize for not being prepared with that right now. If Justin were sitting next to me, he'd be able to spout those numbers off for you. But yes, I can follow up with the details of what that investor perk is. So one thing I do want to mention, and of course, we don't have time for any more questions as we close up. I do want to be respectful of your time and make sure we do close out at the top of the hour, is that, as I mentioned, we do have many opportunities that we're potentially exploring to go into the fund. I showed you the one in Ohio. That one we're on a tighter timeline on. That one we're going to have to make a decision whether we move forward on that one this week. So we may or may not move forward with that one. There's no promise that that one will be in there. But if there is interest in that, of course, you can see more details of that in the investor portal at investors.happycapital.com. And then, of course, we do have other opportunities that are going to be incoming to it, of course, that are going to go right alongside with Beyonder Getaway or Beyonder Resort Cajun Moon. So again, investors.happycampercapital.com is where you can see all the details on the fund, on the property. And of course, if you do have any other questions that we just didn't have time to answer today, or any that come up after the fact, feel free to reach out to Ramesh, Don, who are our investor relations team, who will be able to help you out with this. Of course, I'm also open for questions as well too. But we do appreciate the investment of your time coming out with us this evening. Again, encourage you to jump in the portal and take a look if you have any other questions that come up. So thank you so much for your investment of time today.
I would like to add, Adam, and just thank you everyone for taking time and attending this one. But this is definitely a unique opportunity. We are definitely hoping we will probably get the approval from the bank to move forward on the second largest property in Ohio. So if anybody is interested, I know the fund is already available and open. So just go log in and get your read your documents and get the sign up done and probably ready to wire once we confirm the dates.
All right. Thank you everyone for coming out this evening. Again, please jump on the investor portal, take a look. And if you have any other questions we can answer for you, just reach out and let us know, or schedule a call with one of our investor relations team members.
All right. Thank you so much, guys.
Thank you.
Thank you. Thank you, everyone.
Thank you.
You're welcome. Thank you.